Building on our internal and external analysis of Chevron, this video aims to chart a forward-looking path for Chevron's sustained competitiveness and growth by synthesizing key insights from both internal capabilities and external market dynamics. We, Dauntless, present strategic options and focused recommendations that align with Chevron's strengths, address its challenges, and position it to thrive in an evolving energy landscape. As a recap, the results from our Porter's 5 Forces analysis indicate that the oil and gas industry remains relatively attractive. However, its attractiveness to new players is declining. Competitive rivalry is moderate. Although the industry comprises several key players and high exit barriers, this industry operates in oligopolistic competition, which weakens the competitive rivalry. On the other hand, the bargaining power of suppliers is weak. Although the government sets strict regulations that may limit exploration activities among oil companies, the existence of vertically integrated oil and gas companies limits the ability of suppliers to set prices, hence weakens their bargaining power. Meanwhile, the bargaining power of buyers ranges from moderate to high, as the industry serves two primary segments: the business buyers who possess greater bargaining power and the consumer market who are price takers. In terms of substitutes, the threat is moderate to high, particularly due to growing biofuel market, which is projected to expand at a CAGR of 11.3% from 2024 to 2030. Its rapid growth threatens the demand for oil products in the near future. Lastly, the industry's threat of new entrants is weak due to the capital-intensive nature of the industry, significant capital investment requirements, and strict environmental regulations. In terms of their financial health, this shows the sales and total assets of the three companies. In terms of a 4-year CAGR, Chevron is experiencing strong sales growth and improving asset efficiency, while net income and return on sales have declined. ExxonMobil's sales grew strongly over the past 4 years. Total assets increase, and return on sales and asset turnover are stable. However, net income is declining. Shell's sales and profits are growing, while assets are stable. The company has gotten much more efficient in both making profit from sales and using its assets wisely. Moving on to the ratios, Shell has the most stable liquidity, Chevron shows a downward trend, and Exxon made a recovery but slipped slightly in 2024. ExxonMobil is the least leveraged, while Shell maintains a moderate level, and Chevron shows a recent uptick in debt usage. In terms of asset turnover, ExxonMobil is the most efficient, while Shell's efficiency declined the most. Chevron is in the middle but trending down. Chevron and Exxon have better debt coverage, while Shell experienced a sharp spike in leverage pressure in 2024. In terms of operating margin, all three peaked in 2022 due to high oil prices, but Chevron and Exxon have stronger margin recovery than Shell. And lastly, ExxonMobil has the healthiest gross margin, while Shell trails behind. For the VRIO analysis, Chevron relies on valuable resources such as global upstream operations, advanced refining infrastructure, and brand recognition. However, these are widely available across the industry and relatively easy to replicate. Consequently, Chevron achieves competitive parity but does not possess a sustained competitive advantage. ExxonMobil stands out through its patented carbon capture and storage technology. This resource is not only valuable and rare, but also difficult to imitate and effectively embedded within the company's operations. As a result, ExxonMobil enjoys a sustained competitive advantage, particularly in the area of sustainability leadership. Shell, on the other hand, derives its advantage from its globally recognized brand and strong corporate reputation. This intangible asset is valuable, rare, and highly inimitable, giving Shell a sustained competitive advantage rooted in customer loyalty and stakeholder trust. In terms of strategic positioning, Chevron operates as a market challenger, emphasizing sustainability and energy transition as core components of its growth strategy. ExxonMobil, the U.S. market leader, advances a similar sustainability and energy transition agenda through its dedicated low-carbon solutions unit, while also employing a disciplined investment approach. Shell, the global market leader, also prioritizes sustainability and energy transition, but distinguishes itself through value-based positioning. Despite differences in positioning, all three companies share common strategic themes, including geographic segmentation, portfolio diversification, technological innovation, an integrated business model, and a commitment to operational excellence. Here are the future key success factors. More research and development should be invested, particularly in low-carbon solutions to reduce emissions and mitigate climate impact. Continuous improvement in digital technologies used in operations such as IoT, AI, and cloud computing for efficiency and lower operational costs. Strategically diversifying into renewable energy resources. Continuous talent development and upskilling workforce to prepare employees to manage new technologies and business models. build strategic partnerships or joint ventures for shared risk and better cost control, thereby improving profitability. And lastly, maintain transparent communication with stakeholders. Dauntless identified Chevron's key core competencies that strengthen its global position. Operating in over 180 countries, Chevron holds a brand value of $14.8 billion in 2024, ranking it the sixth largest oil company worldwide. Its refining infrastructure processes over 1.8 million barrels per day, with total refined product sales reaching 2.781 million barrels daily. Chevron has joint ventures and mega projects, such as the Gorgon project with ExxonMobil, Shell, and Tokyo Gas. It maintains a low debt-to-equity ratio and debt-to-cash flow ratio above 1. Furthermore, the company also leverages AI, drones, and robotics for operational efficiency and safety. Through its operational excellence management system and integrated business model, Chevron achieves cost leadership and agility in a dynamic energy market. Building on the internal and external analysis, Dauntless conducted a comprehensive SWOT analysis for Chevron. For strengths, Chevron has a strong global upstream operations, excels in joint ventures and large projects, and maintains vertically integrated operations. It also shows a low risk of indebtedness, leverages cutting-edge technologies, and focuses on cost leadership and operational efficiency. However, key weaknesses include a decline in proven oil and gas reserves from 2021 to 2024, involvement in legal and environmental issues, declining net income, and poor stakeholder communication. In terms of opportunities, the rise of AI enhances efficiency in maintenance and operations. Technological advancement in exploration and renewables support Chevron's transition towards sustainability. GDP growth trends suggest rising oil demand, and there's a low threat of new entrants in the industry. Lastly, the threats Chevron faces are significant: geopolitical tensions, US tariffs increasing material costs, currency volatility, and the growing shift toward renewable energy. These are compounded by a moderate to high threat of substitutes, variable buyer and supplier power, and competitive industry rivalry. To further leverage these insights, Dauntless performed a SWOT matching analysis. Starting with strength opportunity strategies, we recommend that Chevron expand exploration in high-growth regions to meet rising demand for oil. For strengths and threats strategies, Chevron has to strengthen its alliances with its existing joint ventures to stay competitive in a tough industry. Second, reduce the impact of tariff-related costs through internal supply chain control and global sourcing. Third, strengthen the competitive edge by negotiating better supply deals and maintaining low-cost operations. Lastly, leverage financial stability to hedge against foreign exchange volatility and inflationary pressures. Moving forward to weaknesses and opportunities strategies, it is to invest more in AI and seismic technology to identify and tap reserves to reverse the current declining proven reserves. Next is to leverage the low threat of new entrants to aggressively reinvest in exploration and reserve expansion. Lastly, for weakness and threat strategies, Chevron has to increase its transparency by investing in ESG initiatives to improve its image and gain customer trust. Next is to secure long-term drilling rights in politically stable regions, and to build stronger financial strategies to reduce risk from inflation and currency fluctuations. Based on our evaluation of key success factors, Shell emerges as the top performer with a final weighted score of 3.90. This strong position is driven by its leadership in digital innovation, ranking first in artificial intelligence adoption among oil and gas companies. Shell also boasts the most diversified renewable energy portfolio, spanning wind, solar, hydrogen, biomass, and a growing EV charging infrastructure. In terms of continuous talent development, Shell scored perfect 5, achieving delivered 264,000 formal training days in 2024 and supporting employees through platforms like Workday Learning. This combined strengths positions Shell as a frontrunner in driving the energy transition. ExxonMobil follows closely with a score of 3.8. Its greatest strength lie in its significant investment in low-carbon research and development. It also ranks high in strategic partnerships and joint ventures. On the talent front, ExxonMobil earned a 4, reflecting its substantial investment in employee training. However, its strict performance management system, which places underperforming employees at risk of termination, may create added pressure within its workforce. While slightly behind Shell in digital adaptation and renewable diversification, ExxonMobil's strong R&D and partnerships keep it firmly in second place. In third place, Chevron received a score of 3.65. It performs particularly well in talent development, earning a 5 for its inclusive No Degree, No Problem initiative, which provides on-the-job learning opportunities. Chevron also maintains a fair level of renewable energy diversification, but its lower R&D investments and slower adoption of digital technologies weigh down its overall competitiveness. Now, to help craft effective strategies for Chevron, we created a space matrix. After evaluating, it has been found that Chevron belongs in the aggressive quadrant, which means that it may focus on aggressive strategies such as pursuing high-impact joint ventures and partnerships, positioning Chevron as a global ESG leader, and accelerating integration of AI and digital transformation across its operations. Based on the results of competitive strength assessment and the space matrix, Dauntless has the following alternative courses of action. These alternatives are also aligned with the SWOT matching strategies earlier. One alternative course of action would be the strengthened strategic partnerships and joint ventures, for it provides access to expertise and innovation, as collaborating with industry leaders and startup opens door to cutting-edge technologies and specialized knowledge. Secondly, it allows for shared cost and risk. However, this strategy also has its cons. One major challenge is cultural and management style differences. Divergences in company culture, leadership style, or business practices can create barriers to effective collaboration and decision making. Additionally, there are contractual limitations to consider. Another alternative course of action would be to improve transparent communication with stakeholders. This approach brings several pros. First, it can enhance brand reputation. Second, it increases investor confidence. Clear communication on ESG goals can attract ESG-conscious investors and bolster Chevron's credibility. Third, it reduces regulatory and social risk. Proactive engagement with communities and environmental groups can lessen opposition to projects and ease regulatory approvals. Additionally, it is cost-effective, as enhancing transparency generally involves organizational changes and better communication practices rather than large capital investments. However, there is a risk of overexposure. Sharing too much detail could open the company to public criticism or increase regulatory scrutiny. Moreover, there are potential legal and compliance risks, as any misstatements or inconsistency in public reports may result in legal liabilities or regulatory penalties. Lastly, internal resistance could arise, with some departments potentially opposing increased transparency due to fear of blame or loss of control. Another alternative course of action would be to lead in AI and digital transformation. For its pros, it encourages operational efficiency, wherein AI and IoT will enable predictive maintenance, reduce downtime, and optimize energy use. It also results in cost savings, wherein automation and digital workflows can significantly cut operational costs over time. It also results in data-driven decision-making, wherein advanced analytics would improve forecasting, resource allocation, and risk management. Lastly, it would give Chevron a competitive advantage in a way its digital leadership can differentiate Chevron from competitors in low-carbon operations. However, this action would also have its cons, such as workplace displacement and implementation complexity. For the final part, identifying the alternative course of action, two questions were raised. The assessment showed that the two courses of action, strengthen strategic partnerships and joint ventures and lead in AI and digital transformation, tied with a similar number of yes responses regarding Chevron's strengths. These strengths include global upstream operations, joint ventures and large project management, vertically integrated business operations, low risk of indebtedness, integration of cutting-edge technologies, and cost leadership and operational efficiency. This indicates that Chevron can leverage its strength towards both alternative courses of action. Similarly, in terms of addressing the weaknesses, the listed strength and the two courses of action strengthen strategic partnerships and joint ventures and lead in AI and digital transformation, tied in the number of yes and no responses, indicating comparable potential in mitigating Chevron's identified weaknesses. Provided that these courses of actions tied, we recommend to combine strengthened strategic partnerships and joint ventures to pursue AI and digital transformation. To implement the chosen alternative courses of actions, here is our recommended implementation plan. We suggest to begin by mapping opportunities across Chevron's core strength. This includes identifying gaps in AI, CCS, and digital infrastructure, aligning potential partnerships with low-carbon goals and technology leadership. Success here is measured by alignment from leadership and clearly defined opportunity areas. Next, Chevron should evaluate 5 to 10 potential partners, ranging from AI labs to clean tech innovators. The focus is compatibility, ESG goals, and innovation capacity. It is also recommended to host joint workshops to co-ideate solutions. The KPIs here include qualified partners, aligned priorities, and projected returns. Moving on to the next phase, this should include finalizing MOUs and contracts, establish onboarding systems like shared data platforms, and ensure legal, IP, and ESG compliance. At this stage, the aim here is for 100% onboarding completion and formalized training across both sides. This phase's goal is to co-develop solutions such as AI tools for emissions tracking or CCS implementation models. These pilots will be guided by agile sprints with clearly defined milestones. Key KPIs include 90% on-time delivery, measurable cost savings, and at least 2 projects showing emissions reductions. This phase processes joint IP documentation, trademarks, and patent filings, ensuring co-ownership clarity and compliance. The success indicators here at 100% IP documentation and no conflict in ownership. Successful pilots will then be integrated into business operations, whether that's for AI for servo mapping or CCSS for upstream facilities. At least 75% staff adoption is expected with measurable process improvements. Finally, this phase will evaluate partnership performance, extract lessons, and communicate results internally and externally through ESG reports and public showcases. The KPIs here include positive ROI, partner satisfaction, and documented success stories. To track Chevron's progress against its objective, the balanced scorecard will provide a comprehensive view of the company's progress in terms of financial perspective, customer perspective, internal business processes, and learning and growth. For the financial perspective, we recommend that Chevron should focus on reducing operational costs and increasing profitability. To reduce operational costs, Chevron should decrease its operating expenses by 10% by 2027. This is potentially achievable through the deployment of AI-driven predictive maintenance to prevent production downtimes. Chevron should also aim to achieve at least 5% increase in revenues per year by leveraging newly formed strategic partnerships and joint ventures, capitalize on the forecasted decline in oil prices to lower input costs, reduce the purchased crude oil and product expenses, and enhance sales volumes. Together, these initiatives are expected to strengthen Chevron's financial performance. The customer perspective emphasizes 2 key objectives. To increase market share, Chevron should aim to achieve 5% year-over-year growth in key regions by 2027, supported by leveraging strategic partnerships to co-develop and distribute innovative energy solutions tailored to local demands. Additionally, to improve its brand image on sustainability, Chevron should target ranking within the top 5 among industry peers in the Brand Trust Index by 2027. This will be driven by partnerships with global NGOs and ESG rating agencies to enhance public perception alongside the launch of clean energy projects with clearly visible environmental benefits. Moving forward to internal business processes, a critical pillar in driving long-term operational excellence and sustainability. Chevron's first objective under this perspective is to increase proved reserves, ensuring a resilient and competitive energy portfolio. The target is to reach between 10.1 to 10.3 billion barrels of oil equivalent by the end of 2027, representing a 3 to 5% increase from 2024. To achieve this, Chevron should leverage AI-powered servo mapping to gain more accurate subsurface insights and form strategic partnerships to gain access to new, high-potential exploration zones. The second objective is to further reduce carbon intensity. The specific target is a reduction of 0.2 grams of carbon dioxide equivalent per megajoule annually, aiming for a level of approximately 70 grams of CO2 equivalent per megajoule by 2027. To achieve this, Chevron should focus on 2 major initiatives: utilize AI and advanced analytics to optimize emissions across the value chain, and pursue strategic acquisitions of lower carbon assets and enabling technologies that support the ongoing transition to cleaner operations. The learning and growth perspective focuses on 3 key areas. First, the company should aim to retain industry-leading talent by maintaining a retention rate above 90%, driven by enhanced benefits, global career paths, and leadership development programs. Second, to upskill the workforce in AI and digital tools, Chevron should target having 60% of its employees trained in digital technologies by 2027 through workshops on AI, IoT, and other emerging capabilities. Lastly, the company should seek to establish integrated cross-functional teams with strategic partners, aiming for 8 to 9 members per team. This ensures the right functional mix to drive innovation and alignment across joint initiatives. Lastly, from the objectives in the balanced scorecard, this is the strategy map, which shows how learning and growth perspective objectives would improve Chevron's internal business process, which then improves their customer perspective objectives and ultimately their financial perspective objectives. Thank you for listening.